Hello and welcome to Smartkarma's corporate webinar. I'm Sanam Nanwani from Smartkarma. This week we are hosting Taste Gourmet. We are glad to have with us Executive Chairman and Co-founder Kent Wong and CFO and Company Secretary Gerald Yu. We will start the webinar with the team walking us through a company presentation, after which they will engage in a fireside chat with Smartkarma Insight Provider Taneja. We are taking live Q&A, so I would like to request our attendees to post your questions in the Q&A tab at the bottom of your screen. During the webinar, we will also share some links on how you can connect with Taste Gourmet and read more research by Samir, so please do keep a lookout for messages in the chat box. I now hand it over to Gerald to walk us through a short company presentation. Gerald, please.
Hi, thank you. Hi, thank you everyone for joining the webinar today. I'll just quickly go through our company, who we are and what we do. Our company was incorporated in 2007. We are a multi-brand, multi-cuisine restaurant in Hong Kong. Currently, we have 41 outlets. Mainly in majority of which are in Hong Kong. We have 3 in Shanghai. We target CBD and also shopping malls. It's where all of our restaurants are situated. We currently have committed 4 new leases for the 4 new restaurants. So we have Southeast Asian type cuisine, which are the 3 brands on the left, Latte, Sam Sam, and also Khao San. We have Chinese cuisines, which is the one in Daoteng, the one in the orange logo, and also the 2 before the licensed restaurant. We have Moments Together in Shanghai. And then we have we're one more, the Taiwanese hot pot restaurant. The rest are basically Japanese restaurants. We have a couple of Western restaurants, which is Part of You, Tips, and so Western Cafe, which is Q. So we target a mid to high end segments for majority of our restaurants. As for Japanese cuisines, we have the bulk of it are all the buffet style, all you can eat type restaurants. We have committed 4 new restaurants which are located in Hong Kong, basically Times Square, Katelyn Art Mall in Tsim Sha Tsui, Yoho Mall in Yuen Long, and the White, which is the new MTR shopping mall. That one will probably delay till April, because the shopping mall probably won't be ready until April. These are the ones we have already signed leases. We have a couple more that we have received offer letters. One more at the Way, and the other one is Elements, yeah, the Elements, yeah. So these are some of our basic financial metrics. Very basic, right? Okay. In terms of net margins, in 2022 dropped significantly because of the COVID, the social distancing measures that was in place for 2022. Our financial year ends actually March. So our financial year goes from 1st of April till 31st of March. For financial year 2023, we're slightly affected in April. That's why margins dipped a bit compared to FY21. But in normal, I think we're very confident once everything should. The Hong Kong government removed all social distancing measures basically on December 29. So in December, our net margin was more than 10%. So going forward, we believe we should be able to go back to when everything back to normal. We should be above 10, 11 and a half. We should get that margin increase as we open more larger restaurants. We closed quite a number of restaurants in 2000 and FY22 and this year. We closed 5 restaurants last year and 3 restaurants this year. We closed down the smaller restaurants because those were the older ones. So when our company first started, we rented smaller places, but now our main challenge is actually human resources. So we decided to close down the small restaurants and reopen larger restaurants where we would be getting more better return per employee, because when you operate restaurants, regardless of the size, basically you need a minimum set of people. But as we open larger restaurants, the ratio of additional employees is not 1-to-1. So we would be getting better return from per employee if we operate slightly larger restaurants. We're able to achieve very short payback period. The reason being because the break even, most of the restaurants break even during the first month of full operations. Where one, which is the fine dining, took 2 months. But all other restaurants, we achieved that break even point during the first month. Our quickest, in terms of payback, is 11 months. On average, is around 15 months for payback period. This is the impact from the COVID that has affected us during these 3 to 3 years basically. We use June as a benchmark because June into 2020, all social distancing measures were actually lifted. There are no social distancing measure. This is based on revenue per restaurant per day. So basically, for 2023, we are above the even though we still have some social distancing measures, our return from each of our customers is actually higher than the benchmark we use in June 2020. In December, we actually achieved 124%. In November dipped slightly because we closed some of the restaurants were under renovations, and we closed some of the restaurants. That's why November dipped a bit. As I said before, basically 2022, December 29, all social distancing measures have been lifted. Yep. So our strategy is we'll continue to open 3 to 5 new restaurants per year. We actually opened 10 in 2022, but FY 2022, we will close 5. This year so far we opened 6, but we closed 3. We'll continue to introduce new brands, new cuisines, because competitiveness is actually getting into the shopping malls. Good shopping malls will not allow the 2 very similar cuisines to be at the same shopping mall. That's why we have different cuisines in order to get into different shopping malls. Yeah, we believe as we have more restaurants in the same brand or similar operations, the all you can eat, whether it's the Taiwanese hot pot or the Japanese hot pot, that'll give us the benefits of economies of scale. Yep. Well, we're always open to potential M&A, but the M&As in restaurants, F&B is actually quite difficult because a lot of the owners always are really high multiples. So a lot of times are not reasonable. And we'll eventually go develop the franchising model for China. Yeah, this is a quick summary of our company. Yeah, Samir.
Great. Thanks, Gerald, for this summary. It really encapsulates everything. And I just want to thank both Kent and you for making time and coming on this webinar. We understand that it's border reopening time, China, Hong Kong, and Hong Kong's getting busier. So yeah, keeping that in mind, it's great that you could make time for this webinar. So I'll probably start. I just wanted to ask Kent a question. This is on. This is just for the benefit of all investors who are potential investors who are new to this company. Is to try and understand, Kent, how you sort of came into the restaurant business, and you had obviously a very different background, and then sort of just encapsulate your sort of approach to how you've reached this stage where you're one of the better performers operationally in the industry.
Then Sammy?
Yeah, Kent.
Can you ask again? Sorry.
Yeah. So I just wanted to know, we just for the benefit of all potential investors, you've had a different background, and from this you came into F&B, and you've been able to grow and also be an extremely good operator. So just for the benefit of everyone, how this sort of came to be, if you could sort of give a brief of that would be really good. It'll give, I guess, potential investors a very good flavor about your company.
Okay. Here in Hong Kong, we are very familiar the market, and we know the customer need. We know our target customer. So we have target. We have more focus on what they want. And so we would like to create different cuisines to make our customer need, and which is the young market is our major focus on. And so even though we have faced a serious COVID-19 impact, but we are focused on local market more than tourist market. So during this period, we have doing well compared with others. This is our strength, our advantage. Sammy?
Great. Okay. All right. Maybe I'll start taking questions from the floor. And the first question that has been asked is around your goals within the next 5 years. So where do you see yourself from a top line, so revenue perspective, and a margin perspective, and what sort of markets would you be expanding into 5 years from now? Let's see what would you look like 5 years from now?
Yeah, I think we as Gerald said, that we hope to keep the 10% net profit as per our our target. We are looking for this target for based on our experience and our management skills. We hope we can achieve that, and we hope to focus on Hong Kong market as well as mainland China, and we are looking for any opportunity in overseas market for the coming years. And so maybe for number of shops, maybe for this year end, I mean calendar year end, we may more than 50 outlets in Hong Kong in mainland, and for 5 years coming, maybe more than 80. I think it's more than 80 shops is our target. So
yeah, I think the way you look at it is in Hong Kong. We look. I think in Hong Kong, definitely we should be able to achieve 12% net margins eventually. But we're extend overseas because there will be some sales costs and so forth. Therefore, it might impact it slightly. But the way we look, location, it's not that location is not available. There's so many locations available. It's whether we take them or not. We don't want to open restaurants for the sake of opening restaurants. Where when we get, I mean, even good shopping malls like New Town Plaza, right? We even if they give us other floors, we would consider whether we'd take the location or not. But currently at New Town Plaza in Sha Tin, we have 4 restaurants. We saw on the first floor. I think choosing a wrong location would actually be a lot of strain on the management team, and actually a lot more effort is required to put into that one particular shop when the location is not so good. So well, we say open 3 to 5 in Hong Kong, but we already opened 6 this year so far already. Still got 3. This year probably won't be any more because on Chinese New Year we won't take possession of the new locations until after Chinese New Year. So that by the time the new shops are open, it'll be next financial year. So, but the good locations are available now, so that's why it's a good time in taking those locations. The competitors gone down for these places, but not so good locations. There's abundant. But we prefer not to take those. We prefer not to just go for the sake of increasing our footprint and opening new restaurants. Yeah.
Got it. Okay, and just to sort of so to summarize, you mentioned 50 restaurants by next year end, about 80 restaurants in the next 5 years, and so when we look at the split, obviously you've expanded a fair bit in Hong Kong, and your presence is mostly Hong Kong. When we talk about 80 restaurants, is there a geographic split between China and Hong Kong in that? And for China, so if you could just walk through what your plans are now that China has sort of opened up, and you've been 3 restaurants for a while because China has been locked down. So if you could go through that would be great.
Yeah, China is our major target in the coming years, and we are running a little bit high-end business in China because we know that it's not easy to run fast-moving type cuisines in China because the competition is very serious. So we like Shanghai, we have 3 outlets. Our average is about Hong Kong dollar is about 300 per each head count. So that means this is this market is our focus, and we have a good experience on that. And from our running experience, is quite successful in Shanghai. So we are looking for, maybe except for Shanghai, we are looking for Shenzhen and also Guangzhou in the coming years.
Great. Okay. And when we talk about these 80 restaurants that you aspire to have within 5 years, is that split between Hong Kong and China equal, or are you just talking about Hong Kong and China is a totally separate plan for you?
I think depends on the locations. Our decisions are always based on the locations. If we can got good locations in China, we will expand fast. And if we can got the good location in Hong Kong, we will expand in Hong Kong fast. And so it depends. But maybe in Hong Kong should be our major because the maybe economic quite stable here, and the political environment is quite stable here, and we will invest more in Hong Kong.
Got it. Okay. So for are there any other markets that you're looking to expand into besides China and Hong Kong, or will these two remain your major focus right now?
Yeah, we are looking for like Taiwan. We may working with our potential business partner to run our brands in Taiwan, but maybe it's like a joint venture for the business. Maybe we may franchise our brand to them. It depends. Yeah.
Okay, understood. Okay. Another question that people have sort of that has been raised on the platform is, you've been a GEM stock you've been listed on the GEM board for a while, and you had plans to do a main board listing. Are those plans still on, and what's the situation on that?
Yep. I'll take that because we not just planned, we tried. We actually tried, but in 2020, December, because the stock exchange, we were ready to present to listing committee for to get approval for the transfer. The listing division advised us not to submit to listing committee because at that time the listing committee would not approve any retail or F&B related stocks due to the COVID situation, because they said we don't know what's going to happen, so we're just not going to approve any. So they advised not to submit, because once submitted it becomes official. So we withdrew the application. So now that all the social distancing measures have been lifted, we will take a look whether what's the latest from the stock exchange with regards to the profit ratio, the requirement, because the new requirement is 80 million for 3 years. But the split was the first 2 years it has to be 50, and last year 30. Strictly speaking, we won't make it. We don't make that split requirement. But the stock exchange did say that they would relax the requirement. So as long as we're able to get 80, and they're willing to grant a waiver on the actual split. But our year end is March, so after March year end, we will ask the stock exchange what's the real situation is, what's the real mechanism is. So that'll probably be after we announce the results in early June. Then we'll submit a letter to a submission to the stock exchange, request a ruling of some sort, and then let's see and plan from there. But so if this year cannot be done, we'll probably commence process for 2024 March year-end financials will definitely be enough for that.
Right. Okay. So another question, I guess, pertains to your portfolio. You've got several brands in your portfolio. You've got Nabe Uraba, you've got Tokano Ramen, you've got Moments Together, you've got Terps. So the question is around how you look to optimize your portfolio, given it's got so many brands. Are there any that specifically perform well for you? And if so, would there be a consideration around sort of letting go of certain brands that aren't doing well, scaling down and in the terms of the number of brands, and then sort of like looking at synergy for that from that front, and then sort of expanding margins that way?
We like all you can eat market in Hong Kong is very big, and so we have created different type of all you can eat hot pot and all you can eat yakiniku. These types still have room to grow in Hong Kong, and so our brand can expand more in Hong Kong for the coming years. So the market is still so big for us, based on our experience, and because this is our advantage, because why we have created different cuisines in Hong Kong, and different types of people, we can deliver our cuisine to them to meet their demand. So this is our our policies to make it more competitive with others. So we are still looking for it.
Yeah, I think, and also because I mentioned before, some challenge is actually staffing, right? I think that's the biggest challenge for not just F&B, for most sectors. For all you can eat, we actually do not require that many headcounts. Although the food cost is more, but the staff cost is lower. I think so in terms of for us as an operator, all you can eat type actually works better for us. Though I mean, we have been scaling down for the likes of Latte, so we have 5 now, we only have 2. We're switching it to the other branding like the Sam and Khao San. So modernizing the whole branding experience. Yeah, we understand. When we first incorporated lattes, it was back over 10 years ago when the requirements for a Vietnamese restaurant is so different from what's required now. And now it requires nice decorations, nice plating, good services. I mean, 10 years ago, it's more like a Fantan the way it's operated, right? So we would see different requirements will actually determine branding, and dining experience.
Right. Understood. Oh, that's really clear. So it seems like you're going to keep your approach multi-brand still, but evolve each of your brands so that you're sort of catering to the taste of the market. I understood.
Yeah.
So on China, there's a question around the returns that you get for your Chinese restaurants. I mean, obviously, it's a little difficult to answer given you've expanded just prior to COVID.
Not just that. Okay, the return should be better than Hong Kong, definitely, if it's operated properly. But of course, our team is actually small. We need to expand the team, and it's very hard to tell you when we were actually at 0 revenue for 3 or for a couple of months, in China when they just shut everything down previously. But normal situation should be better. The return should be better for restaurants. So,
Okay. In the months that you were operating and you weren't affected by COVID, maybe if you could provide a flavor as to you've seen you've provided good data on your paybacks, and your payback is around 11ish months or 15 months on average, and then break even is 1 to 4 or whatever. So how is it in China? I mean, if you could give a sense to everybody, and what net margins are in China. So your restaurants now have a 10% plus net margin.
Yeah, but I can only tell you that will be quicker.
Okay.
Than what we can achieve in Hong Kong, but I can't definitively give you an answer though, because of the the fluctuations and
fair enough.
But
fair
it should
enough.
be
Okay.
Sorry,
Okay.
Sammy, sorry, I need to go.
Sure,
Ken. Thanks.
All right.
Joe
Okay.
will follow the questions. Thank you. Thanks.
It's very nice of you to join us, Kent. I understand you're speaking to
Very
landlords
busy.
and all, so you'll be fairly busy with that. So it's an honor to have you, and thank you so much, Kent.
Thanks, Sammy. Thanks.
All right.
Bye.
Okay. So maybe the other question, I guess, on the platform is, you've got a lot of cash on your balance sheet. It's around it was around 117 million at the end of the first half. So would you consider raising your dividend payout, or given the cash that the cash flow generation is improving, you've got a lot of cash already on your balance sheet, and expansion or capex is maybe 3 to 4 million a restaurant. So if you're expanding 5 to 7 and you've got this cash flow, you can afford to pay a higher dividend.
Yes, that's what we have in plan. We also did some repurchasing.
Right.
Yeah, but we would like to maintain a relatively high dividend yield to the yield. Yield therefore translate to payout ratio. But in terms of new restaurants, we want to invest some money into the supply chain as well.
Okay.
So securing
right.
Yeah. So, but that won't be significant.
Right.
Yeah. But even after doing all those, we should still have quite sufficient cash on balance sheet.
Understood. Okay. And just for the benefit of everyone, your payout ratios are dividend payout ratio is around 50 plus. Do you intend to hike that further?
Our policy is at least 50%, but look at the first half of the period was significantly higher than 50.
Yes.
I can't remember the exact ratio, but yeah.
Okay. The intention is to stick to that higher ratio.
Yeah.
Understood. No, that's pretty clear. All right. Another question on the platform is about your costs. So maybe if you could walk through how you've been able to manage your costs, because there's been a lot of inflation. So yeah, that's one. And then the other, which is around the same lines, is what's the secret sauce for your success on having these 10% margins? What do you think that enables you to have superior margins over your peers?
Okay, so our food cost is around 30% as a percent of revenue, which is already gone up already. When things were normal, we were achieving around 28%. So it's basically gone up to 2% already in terms of the food costs. Staff costs I think it's what needs to be controlled. Whereas to a certain extent, food costs if certain products gone off significantly, we just have to switch to different products or different materials. Right. I mean, we were struggling heavily with the beef, the US US short ribs. The cost jumped up significantly, so we had to switch to UK beef. We had to switch to Australian beef or we still offer the US beef, but the price would be a lot higher. So people were paying for the same price as the US beef before for UK beef or Australian beef, but we still offer the US beef but at a higher price. For in terms of staff costs, I think the way, I mean, you probably saw a news that they're increasing minimum wage to $40 from 34.5. But no, for us, our part-time, we're paying 60 already an hour. So it's not going to have much impact. In that regard, it's the way we are able to control it is switching to larger restaurants where we get a better return per employee.
Right. Understood.
So in the control that. I mean, okay. In terms of the rental, which is basically the three main costs. During COVID, of course, we fell below the turnover rent ratio. So we fell below the turnover ratio as a percent of revenue would be significantly higher than what it should be. So if we're able to, all our restaurants hit the turnover ratio, ranges from 12 to 14%, plus 2% management fee and aircon fee. Basically, as a percent of revenue, it should be around 16 to 18%, and that's all if we're able to hit that turnover rent ratio. And for the shopping malls, if we're able to hit the turnover rent ratio, our revenue is actually very good already.
Okay.
So it's just that how efficient the restaurants are operated, and also in terms of control the other expenses, like marketing expenses. Whether if we spend money for marketing expenses, how much return are we getting from it? We do try to measure those things. So as you can see, our other expenses are basically controlled around 5% as mentioned of revenue. I mean, 10% net margin, it's thin. So every percentage counts, basically. So that's it's a restaurant business is it's profitable, good cash flow, but in terms of management, it's actually very hard indeed.
Yes. Got it. Okay.
Yeah.
So another question on the same thing, expansion into different brands, taking the tack on from there. Building multi-brand restaurants would sort of require a lot of hand-holding from you and Kent, and might get hard as you grow. So are you bringing on more experienced management to help you expand? Other part to this is there incentive plans for retaining staff and talent?
Yeah. No. We already have a team for expansion in different cuisines. Every cuisine, like Japanese or Western or Chinese, we already have a different lines, different head chefs, different operations for those different type of cuisines. So we expand within those cuisines. It's fine. It's more to do with the dining experience. There's more to do with the design of the shop, more to do with the design of the menu, rather than having to spending a lot of effort to actually. Well, it's actually sorry. It's still quite a lot of effort in terms of developing a new brand. But it's not something that it's we already have a good different teams to handle all those. So we don't really have to get a lot more people in to help us with that. Sorry, Samir, was the second part of the question?
Right. No, it's just okay. So you've just whether you have incentive plans in place, like options, incentives, etc. To sort of keep your employees retained, because it's such a tough market now for as far as retaining employees are concerned.
In terms of the key employees, we have sheltering plans, and we do have bonuses for the key employees. We have a different set of bonus plans for incentive plans for employees at the operation in the shops. But those are really basically for the shop managers and the chefs for those restaurants. The junior staff is the turnover. It's huge for junior staff. They cannot be retained. It's just very hard to do.
Okay. So do you like have central kitchens and just sort of like an understanding into whether like you're looking at that possibility of having a central kitchen in this is one of the questions that's been asked.
Yeah, as a matter of fact, we are looking at a location around 7,000 square foot.
Okay.
Yeah, well, I mean that will act as a central kitchen as well as a sort of warehouse for these who want to invest in terms of the supply chain side of things, like for storage and also in order to lower our costs in terms of the purchasing cost as well. And some of our restaurants are the numbers are getting there, so it makes sense to have a central kitchen for some cuisines. Yeah.
Okay. How do you ensure quality of food supply? And like in the sense, the standard of food is really good. Like how does that like sort of happen across your entire portfolio of brands?
Yeah, so we have a head chef for each cuisine, and also a head chef, and we also have a sort of head chef that oversees all of them. It's the and also of course training for chefs that in order to replicate the same items across different restaurants. Of course, there are times where basically we just have somebody constantly monitoring feedbacks from customers and also the quality of the output. It's
Okay. All right. So another question that's being asked on the platform is, do you intend to incorporate robots in your restaurants, and like sort of what's the plan as far as automation is concerned, and do you see that as a threat?
Well, I don't actually see that as a threat, because it's how much would it actually affect? I should say. I mean, so the actual cooking, you see those sorts of the fried rice and things like that, but preparation still there is no difference. It's just that couple of minutes time, actual cooking time, right?
Right.
You still need the people to do all preparation and everything. It's still the same. I mean, that person would could also do the actual cooking. So
Right.
that, there won't be actually, we believe there won't be actually significant savings.
Right.
And we, I mean, I have known cases where at the science park in Hong Kong, where they have, a science park, they require things like that. I mean, those restaurants are gone already. That deploy robots. Right.
Understood. Okay. Yeah. Another question on the platform, again, about your cash position is you guys have a cheap share price now, very strong cash position. We talked about the dividends, but are you looking at becoming more aggressive on buybacks as well? You'd already done one where you bought back 2%, I guess. So I think the question around that.
We I mean, of course, the share price gone up recently,
right? Yeah,
the past week or so. But of course, we will look at it. As we are a jam company, it becomes difficult because we're always in blackout. Mostly, we always seem to be in blackout. So Windows are actually not that.
Yeah, you report 4 times.
Right?
Right. Yeah. When would you be reporting your third quarter?
8th of February.
8th of February. Okay. All right.
Yeah.
Okay. Another question is around, it's early days, but I guess people wanted to get like some sort of a handle on what restaurants of yours are geared to people who actually come from the mainland. And
not many.
Sorry?
Yeah. Not many. We actually cater for, we build all our restaurants to serve locals. But of course, you'd say, so we don't directly go for tourist businesses. However, if they come, of course, when they do come eventually, it will help us because they'll take up spaces in other restaurants.
Right. Okay. And then in another question on that is like, what prior to COVID, what percentage of your customers were actually mainland customers? If you have
we don't track
that. Okay.
No, we don't track, but the majority are local. We prefer for returning customers businesses. We build our philosophy around returning customers because returning customers is easier to upsell. We want to upsell to existing customers rather than just do the one-off tourist businesses.
Right. Okay. Great. I'm just looking to see if there are more questions on the platform coming. Yeah. So there's one more about each of your dining brands in Greater China having its own life cycle, and then after that, like hype sort of dies down. And do you foresee any of your brands in your group experiencing this bottleneck as we speak?
Well, we don't agree with that philosophy.
Okay.
Because we build a restaurant and a dining experience. Dining experience being the quality of the service, the output of the food, and I mean, what I say, dining experience matches the customer expectation. So when they come into restaurants, the money they're paying, does it matches what they expect to get in return? I mean, that's very important. That regardless, it doesn't matter. It's $30 or $1,000 per head. Right. So it's as long as we are able to continue to produce this, or shortly translates to value for money, right? Value for money being that it matches the expectation of what they're paying for.
Right. Got it. Okay.
The hype will not die down. They will always come back eventually. I mean, it's when you, I mean, our attitude is okay. A lot of landlords they want to have brands from overseas. overseas brands, right? Of course, at the beginning, it is a hype, right?
Right.
Basically, you save 6 months of marketing expenses, but if you're not able to produce that value for money concept, it won't survive. Even though it's a new brand, even though it's a brand from overseas, it's eventually it's all go back to this value for money concept. Right.
Okay. Another question is on who your biggest landlord relationships are right now, and what's the situation as far as rentals are concerned? I mean, are you getting benefits from there, given times are hard, etc.?
Okay, so landlords basically the Songkai, the New World, the MTR, the Sino, Anglong, Swire. These are all very good landlords. We don't have any shopping malls in Changong or Henderson Land. We don't think they're very good landlords because all the other brands manage the shopping malls very well.
Right.
The percentage ratio between F&B and retail is a good mix. Even the F&B mix is controlled very tightly. So basically, those are the Chinatown as well, which are the most of the restaurants are situated in these shopping malls. And the second question, no, rent's not getting cheaper, but it's just better locations.
Right. Yeah. Okay.
Easier to get good location, very good location. Previously, it was very hard to get into.
Right. Got it. Okay. And another question is, what average revenue per store do you target when you open it? Or is that how you look at things anyway?
Okay. It's put it this way: it's different shopping malls and different requirements from the landlords, right? And they measure the requirements based on revenue per square foot per month.
Right.
Majority requires around 400, 500, 600 Hong Kong dollars per square foot per month.
Okay.
New Town Plaza requires 1,000.
Right.
But we're way over 1,000 for New Town Plaza. So it's basically our criteria for we just set a basic. The basic is as long as the basic revenue plus the management fee, aircon fees, it's less than 20% of revenue. So we take the cost offered to us and work out what's 100%, and whether we see that 100% is easily achievable or not. The revenue,
right?
Everything okay? That's easily achievable. Then basically we will take that location. Yeah, that's how we benchmark it.
Right.
Yeah. So you all have got to spend a lot of effort before we get that 100%. And
right.
Usually we don't take that location.
Right. Okay. Another question is on the China JV. When you expect it to actually start contributing to growth? I mean, it's I guess pretty subjective, but I guess if you have any view on that.
Yeah, because we had expansion plans before, but we couldn't travel China. We couldn't look at locations. I mean that's all gone. But now it's open up again. Because for us to go into China, I think it's getting good locations. It's won't be too difficult. And we build a team.
Okay.
We build a team up. I mean, we have to leverage on team's experience, or actually leverage on the team. yeah, we just couldn't do anything when we couldn't travel up to China. But I think after Chinese New Year, we'll be proactively go and look at the potential locations.
Understood.
For the expansion.
The question is there a loyalty program, and how many members or so are connected to this if there's this sort of an ecosystem present?
Yeah, we've just launched a new CRM program, a membership program. I don't have that data yet. I don't probably we could try and get the figure to you, but we only just recently launched in December, so
okay.
Yeah,
sounds good. All right.
Yeah, it's an app. You can actually download the app.
Right.
Mm-hmm.
Okay. Got it. All right. Okay. Another question was on actually you probably just answered this. The revenue per square foot and the total number of square feet, and I guess you've sort of elaborated a bit on this already. So, all right. If there are any more questions, let's see if there are any more questions on the platform. Else we can wrap up. I do not see any more questions on the platform. Just one more, I guess. Ballparkishly, what sort of growth would you expect in financial year 23 and 24?
Well, I think top line growth will be quite significant compared to FY 2022 because of we didn't have a full year of normal operations, basically. And the new restaurants we open are larger, so they'll contribute quite significantly for FY 2023.
Okay. Is it fair to say you'd have over like 700-ish million of revenue? I think that should be achievable, right?
Yeah. We should get it this year.
We
should get around that this year.
That's your FY 23, right? So you'll achieve that.
FY 22. We probably get that FY 23. So sorry.
So FY 23, you'd be definitely over 700-ish, and then what about FY 24?
Wow. My guess is that what we require should be over 1 billion.
Okay, over $1 billion Hong Kong dollars. Okay, so I guess with a 10% net margin, we're talking about a 70 million profit in FY 23 and probably over 100-ish million in FY 24.
Yeah.
All right. I mean, thank you so much, Gerald, for sparing us your time, and it's really been nice chatting with you, and thanks for answering all these questions on the platform as well. Thanks.
Thank you, Samir, for some very interesting questions, and a big thanks to Gerald and Kent for a detailed insight into Taste Gourmet, the challenges in the market, and the opportunity for Taste Gourmet. I would also like to thank our attendees who joined this session live. With that, I would like to wrap up this week's corporate webinar. Thank you again, and have a great weekend ahead. Thank you, everybody.
Thank you. Bye-bye.